my bigger takeaway was how unsynchronized the global economy seems to be now in terms of where we are in the cycle. Usually it's, U.S. catches a cold, the rest of the world gets the flu, maybe with a lag. I don't know if that's true this time because Hong Kong and China seem to be inflecting off the lows.
Paulo Macro, thank you so much for joining us again, mate. It's been a while since we last spoke, and there has been heaps happening in the world of metals and mining and markets more broadly. One of the big themes that I'm keen to jump into first is your idea of the present super cycle we're in and how that kind of contrasts with the China bull market that we saw in the 2000s, where you really sort of cut your teeth in. So I'd love to kind of start right there and hear your evolution on thinking in this super cycle, the rolling crack-ups thesis that you have and everything related.
Oh, wow. Well, first off, thanks, fellas, for having me back. I guess I can't believe a year has gone by. I think it's been a year. And I'm sorry. I know you guys have been reaching out for a while now to have me back. And I've just been completely snowed, as I think you boys like to say, although it never snows in Australia. So I don't know why you guys say it, but you're taking me way back. This is kind of one of my first framework notes when I first moved to Substack. So it's like really big picture how I think about the world in comparing today, or more like comparing and contrasting today versus the 2000s. So happy to jump in right there. I think for me, in starting out in the 2000s, especially with a commodity bent, as a kind of a young bloke starting in the business, and actually one of my first assignments was Australian equities. So I've got a very soft, sweet spot in my heart for you boys down under, and been there many times. And in my 20s starting out, the cycle was just getting going, but there were a couple of key points that were different then versus today. For one, you had a very clear demand pull from the emerging China. We all know that story. But that kind of measure of a rising tide lifting all boats did some interesting things to a space that had been mostly cast aside for the better part of 20 plus years, going back all the way to the 70s, which was kind of our last big commodity secular bull. In this case, with China's coming out party after the WTO and the rise of China and Chinese demand hitting that kind of S-curve of GDP per capita that a lot of people talk about when they think about global South, India, and Southeast Asia today, you had a situation where two things happened at once. You had that kind of general demand pull where the entire demand curve pushes out and to the right. And you also had an interesting exercise come out, I believe around 2004, where McKinsey dropped a research note report arguing that if you took your typical equity and bond fixed income allocation and added a passive commodity exposure via futures to those two, even around the edges, what they found was two amazing things. One, the returns from commodities historically were uncorrelated, near zero to either of those asset classes. So it made sense as a bolt-on to 60-40. And more importantly, that as all of these curves, which naturally want to sit in contango, if you want to store a commodity, you need a contango where the near-term price is cheaper to the farther dated price to pay for shipping, storage, in particular storage and insurance. Then as you backwardate, which is the curve's way of punishing stores and calling supplies out to the market, you passively begin to collect a yield. So you were basically ringing the dinner bell for pension fund allocators who were looking for other options. And remember, this is in the early mid-2000s when hedge funds and alternatives were just starting to get going. So, hedge funds were in an allocatable asset class the way private equity and credit is today among universities, where 40% of their billion-dollar endowments are in privates. Back then, it was really stocks and bonds and a little around the edges, and the David Swenson, Yale University CIOs of the world were playing with alternatives around the edges. But the mass market kind of long-dated saver insurance companies, pensions, what have you, were only starting to wake up to this. And this McKinsey report woke people up to the fact that you had non-correlated A and positive rolled yield B. And if you basically tell somebody that you have an uncorrelated asset class that generates a positive yield in an environment like the early mid-2000s when the Fed had cut to 1% and basically kicked off the real estate bubble in the US, that was like ringing the dinner bell for large allocators. And so commodities rose as an asset class, and we saw $300 billion of AUM flood into the space during that boom in the 2000s, which all, of course, was miraculously crowned and ended with the demise of Lehman Brothers and the financial crisis in '08. There was an echo boom coming out of that, but by 2011, that was the ultimate top of commodities in emerging markets, and we were done. The difference this time, kind of setting the table with that, is you don't have a very clear demand pull in one particular place per se. The dollar has been gradually strengthening for 10 years, which has kind of been a boot on the neck of EM since 2011, as we know. More recently, Trump seems to want to change that. The debasement trade is underway. It's starting to catch fire as a longer-term narrative. A weaker dollar will, be a kick in the butt for emerging market demand. That's all great. And maybe India owns the second half of the 2020s or the 2030s. And some of these economies, very large, are hitting their S curves now, as they kick through $2,500, $3,000 GDP per capita. But the real driver so far of commodities has been the supply constraint that followed the boom, where basically the tide went out for 10 plus years via underinvestment. And that underinvestment shifts the supply curve in, as opposed to the China story, which pushed the demand curve out. The outcome is the same. You get a general appreciation starting in the price level, but it reflects in the market in a different way. Whereas the backward dating curves driven by China is a rising tide that lifts pretty much all commodity boats at around the same time. Here, what we're seeing is different commodities run into the wall of shortage, or a production crack up or a slip up at different points in time, which actually is Christmas for an active commodity manager or someone who wants to take a longer, short, active approach. And I call this also the forcing function in commodities. They seem to do nothing for a long time, and then suddenly they'll work 50% out of nowhere over a few weeks or months. And that forcing function in commodities is expressed because someone has a problem somewhere or needs delivery tomorrow. They're price insensitive and they need to pay that price. It's the opposite effect of what's happening in fixed income and equities, where the forcing function for fixed income, for example, nobody does fundamental work on rates anymore. I mean, they do, but they're wasting their time. You talk to a rates guy or a credit guy who used to do this 20 years ago, he'll tell you he used to build fundamental models around rates, growth, inflation, what have you. Today, he spends almost all of his time wondering, what's the Fed going to do? What's the Treasury going to do with the TGA, the RRP at the Fed, the interplay of liquidity up, liquidity down? What does that do to bond prices? The changing mix in coupons versus T-bills, how that changes bond prices. It's all flow. In equities, you guys are well aware of the drive of passive, the buybacks that chew through the float, and the more that you can quickly buy back stock, the more that momentum kicks in, puts you into mega cap territory. The inelasticity as these companies get bigger in terms of $1 moving their market caps 10, 20, 30 bucks only makes them more big, which means that passive needs to buy more. Around and around we go in that kind of positive reflexivity of momentum and size. That all argues in equities and fixed income for a passive approach, because alpha or value just does not work. In commodities, it's the exact opposite. The forcing function that I described, where this stuff goes nowhere and then suddenly it pops or it starts to trend and move, argues for the return of a commodity active manager, as opposed to blindly allocating $300 billion to the space, because the space in general, if you look at the Bloomberg Commodity Index, the BCOM or what have you, hasn't really done anything. But individual commodities have been rock and roll over the last few years, including during this bear market in several things. By way of example, when the light bulb went off on these rolling crack ups for me in commodities, we saw European natural gas, the TTF contracts, go nuts in the fall of 21, along with thermal coal. Then in February of 22, we saw that wild as shit Chinese guy get caught short on the LME in the nickel contract, and nickel went to 80,000. They had to bust trade, so you don't even see some of the prints. And then within 2 weeks, oil mooned because Russia invaded Ukraine. We went to 120. In 23, you saw uranium go nuts from the 50s up to north of 100. In 24, we've started to see kind of copper with fits and starts. Like there are things to do. And I think part of it is that as we run into a temporary or structural supply constraint that manifests from several years of deficit finally showing up in price discovery, you see moves happen really big or trend for far longer than you can think possible. But the compression until it happens is very difficult to predict. You just kind of have to hold your nose and be there on some of this stuff. Like, I know guys who were pitching platinum early last year, they had to wait over a year. And then when they got paid 60% in the last 3 months, right? 4 months. So it's Christmas for an active approach, as opposed to what we see in fixed income and equities, where the passive approach just does not seem to want to relent, and doesn't stop rewarding the lazy, or the lack of analysis. So that's kind of the light bulb going off for me on how this super cycle is different. What's going to really be interesting, and what I've been wrestling with more recently, I haven't even written about yet because it's been hard for me to articulate all this, is I'm starting to see signs that all commodities are starting to move together again, like the 2000s. I'm sure you noticed as well, oil and tankers will work on the same day. That's not what the experience has been over the last few years, but nat gas is working too. Uranium is off the mat. Metals are starting to work. It kind of feels like on some days, everything is going, and then we chop wood in different kind of corners of the commodity space. I wonder if the rolling crack up story is kind of marrying and having a bastard child with India and these other places, and the demand statement also coming into its own here. Maybe it's a little early to say that, but now that I'm seeing on a more consistent basis where the entire asset class will move together, it's hard to parse whether what I'm seeing is a demand pull statement where that curve is moving on to the right in conjunction with the supply curve moving up and to the left, or if it's really just as simple as like it's debasement, bro. Like, Trump is, annihilating the dollar. We're speaking Portuguese. We look like Africa. I like to say this is Africa, like the Leo DiCaprio gift from Blood Diamond. Maybe it's all three. As Forrest Gump says, like maybe it's both. But it's a fascinating time to be involved in commodities, but you got to stay on your toes as well. It's a lot to track. For me, who was around in the 2000s, where especially because I was passive back then, like you could make money buying almost anything. Being more active in your research and in your trading can yield a lot of results, but it's not accessible for most people because you really got to commit time and energy to staying on top of everything. Plus then you throw geopolitics in the mix and what to fade, what to go with. It's a wild time, but yeah, that's the framework of how this time is different. It's a similar super cycle. It'll eventually all work, but a more active approach, I think, is yielding much more interesting results and more alpha than the typical kind of blindly allocate to commodities as an asset class. And if anything, commodities are so small in relation to S&P and global fixed income markets. It's almost like there's no room in the space to handle. Like if somebody wanted to send $300 billion the way they did into the S&P GSCI index in the early 2000s, the space can't accommodate it. It's like elephants through a keyhole. Inshallah, that money comes, then we can all retire together. But for now, that's kind of how I see it.
That's a wicked framework, Paolo. I'm not sure I see like the all the commodities moving together just yet. I think like my observation so far is there's a lot of fragmentation. There's froth which is correlated, and then there's other parts of commodities markets which are getting no love. But I totally kind of agree with your characterization of there are pockets of these of certain commodities where supply is the story, and that supply looks incredibly tight, and it doesn't take too much to really move the needle. Let's start with copper, because this is a copper supply story right now.
Sure. So copper, I'm very excited about. I have been bullish for the last few years. It's felt like just chopping wood in a wide range, but I had the front row seat in the 2000s for when we re-racked the copper price stack from, kind of 40 cents on the bottom to $1.50 on the top for 2 decades. And then we moved, I believe it was in 2005 or 6, into that new range where we finally took out kind of 130, 150, and we reset a new range of kind of $1.50 to $4. And we've been working that range now for 20 years, pretty much. We've tested this kind of $11,000 level on the LME, $5 a pound equivalent, several times over the last few years. It has been kind of a fight. You get excited, we're finally going to go. The industry all agrees if we're going to incentivize greenfield investment, we need to see north of $10,000 a ton, and it needs to stick, right? That importantly is what guys want to see. And we've never quite gotten that sort of come to Jesus shortage moment where the curve firmly backwardates all the way through. We've had the farther dated curve sit in backwardation for a little while, but there's always a little hump in the front, which tells you like it's almost like that. I guess I think it's Thomas Aquinas, like give me, chastity or whatever, but not yet. The curve is playing with there's a structural issue, but in the fronts, you've always had a couple of months of contango where it's like, but there's no shortage right here. So we're not going to price in a backwardation and like really show the market that we need metal out of storage wherever it is. What's interesting is the drama and the kind of bifurcation, I guess is the word, or the carving up of the world, and this sort of supply chain crack up that started with COVID now rolling into a multipolar, we hear that word a lot, multipolar kind of regime that Trump's kicked into high gear with, the return of this Monroe Doctrine. Like, these are the Americas, LATAM and North America, that's ours. China, you worry and you do you. Europe, whatever, you guys are a museum anyway, but like, don't come into our backyard. Now we're flexing on Venezuela and just send aircraft carriers, right? Like, just to make sure that everybody else in LATAM gets the message. Like, we don't play. This is our yard. You're just sitting in it. And, we'll fuss less about Taiwan and what have you, while trying to keep Australia in the fold. It's interesting because this is having like real effects. Like, not all supply is created equal anymore, and jurisdiction is mattering more than ever. And you're seeing, even in the case of COMEX versus LME, where the premium on COMEX blew out in a huge way, and then Trump came out and backtracked on his tariffs, and COMEX crashed and had its biggest down day ever. Felt like, I guess, like a buck in a session back this summer. But the premium is still there, and it's still wide. And it makes you wonder, like, if tariffs are off the table, why is COMEX still trading at a premium, especially when there's an ocean of metal now, like 2/3 of exchange metal for copper now sits on the COMEX. And the COMEX used to be just a backwater rounding error to LME in Shanghai. And yet 2/3 of visible inventory is sitting in the US. Like, how is the COMEX not trading at a discount to LME, right? And, I wish I had easy answers. I'm sure metal guys do. Maybe it's just the optionality that Trump, pivots again and says, no, tariffs are back on. Like, I don't know, but it's showing you that there are mechanics at play. It's Christmas for physical traders, right? The Glencore bros of the world, they're minting it, but they're also taking losses when they get it wrong in a big way. Like, mistakes cost a lot of money in metals trading now. But I don't know, man. Like, for me, we're living in a new regime where not all jurisdictions are created equal, and it's not as simple as saying, oh, it's in Africa, so it should trade at 4 times P. Canada should trade at a premium. Like, there are other things now in the mix. When you look at the equities, you look at what should be developed, what could become a mine, versus like where the premiums are. And more interestingly, you guys asked me before we started about my recent trip to Asia. The one thing that struck me, many things struck me going to Hong Kong and Shenzhen, but my bigger takeaway was how unsynchronized the global economy seems to be now in terms of where we are in the cycle. Usually it's, US catches a cold, the rest of the world gets the flu, right? Like, maybe with a lag. I don't know if that's true this time, because Hong Kong and China seem to be inflecting off the lows, even just at the margin. When I talk to the expats in Hong Kong, for instance, a lot of them haven't come back yet, but the ones who are there seem to suggest to me that like the vibes are getting better. Things are improving. They're off the lows. Business has momentum. It feels like they're just kind of getting going into a cycle, like kind of early-ish mid-cycle. Whereas in the US, it feels really long in the tooth, right? And all hinges on fiscal and stimmy and what have you. So we're unsynchronized in Asia versus the West. Who knows where Europe is? They just seem to be stuck in the mud forever. But that's also playing into how metals demand flows through, where if you think about post-COVID, the dollar strengthened and a lot of commodities rallied with it. It was clear that it was a Western demand story driving the narrative around U.S. consumption, goods consumption, some infrastructure investment, CHIPS Act, what have you. Now all the metal is here and the price is still traded at a premium, but something else is going on. Like the rest of the world is starting to feel a little tighter when I look at time spreads on LME, when I look at stocks remaining low on Shanghai and LME. This metal on COMEX is not going back out. So there's exciting stuff, I think, happening in copper that suggests to me we've tested this $5 a pound level enough, or should I say LME, $10,000, $11,000, mid tens, thousands a ton. An old buddy of mine used to say, if you knock on a door enough times, eventually it opens. Like we've been knocking on this level a lot over the last few years. And I think we go. And I think when we go, we're going to re-rack to a new price deck in the same way that we re-racked that price deck in the mid 2000s and never looked back. So what if, a $4 ceiling for so many years now becomes like a $3.50, $4 floor with a $7 or $8 ceiling? Guys on Wall Street are already working with $5 long-term copper, $10,000 long-term copper. And the economics for a lot of projects, especially advanced exploration, look okay at 4. They look really attractive at 5. And oh my God, you start running 5.5, 6, like it's really exciting for a lot of stuff on the come. And there are a shortage of projects out there as well that like are large scale, high IRR. Sorry guys, it's late here. I've been drinking. Things that the majors who have been sitting on their hands for 10 plus years doing buybacks and dividends and focused on capital returns can really sink their teeth into. So it's an exciting time. And that kind of dovetails into another note I wrote recently when the Tech Anglo tie-up came out. I wrote a note called The Ultimate Mining Contra. For me, Anglo is the ultimate mining contra. And, I can point to buying Ike Batista's iron ore assets in Brazil literally a month before Lehman, buying De Beers in 2012 or 13, right when lab-made diamonds were becoming a thing. What a disaster that's been. Selling out of their Thungela, South African coal assets, literally right at the lows coming out of COVID. And now more recently, selling out of, platinum or spinning it off, with platinum having coiled, around $1,000 an ounce for, 15 years. It's the longest basing I've ever seen on any commodity, I think. So these guys, their timing is impeccable. And the fact that this deal is happening now would normally give me pause, like, is that a top? And it's actually quite the opposite. It's the end of chapter 1 in the cycle. Usually you see the bigs try to rationalize in stage 1 of a mining cycle. Stage 2 is defined as guys starting to do targeted M&A of junior producers or even some advanced exploration plays that are ready to go, with a view towards replenishing reserve life, because the price deck will eventually answer the reserve life question, right? If you're BHP and you're sitting on X number of years reserve life at $4 a pound and you take copper to $5 a pound, voila, reserve life got extended just because the copper price went up because there's more copper in the ground that's economic at that price point. But as long as the price deck hasn't firmly re-racked into a new range yet, then once you kind of tapping into the edge of the range and you're starting to show signs of breaking out, you will see majors start to bid on junior producers in the space so that they can just add production quickly at what's still perceived low multiple, and accretive for these guys because they tend to trade at higher multiples than the junior producers anyway. We're just starting to see fits and starts of this. I mean, there was the big Vicuña District deal where BHP and Lundin teamed up to buy Jose Maria and Filo. Obviously, that's a blockbuster project, kind of in its own category. But there's signs that these guys are starting to move on junior producers. And I think what we saw in 2005 and 6 was that cleaning out of the middle. There's almost no middle to speak of because very few people have risen into that stage. But back then it was Falconbridge, Inco, Phelps Dodge. Those three names actually tried to get together in a 3-way at one point. But there's like a whole 9-month saga where, it was bid, counterbid. Eventually Falconbridge went to Xstrata, which is now Glencore. Vale took Inco and the Voisey Bay assets at Sudbury. And I believe the last one, Phelps Dodge, went to Freeport. And you don't really have these kind of large cap, mid-large cap mids getting cleaned out. So you're left with an Anglo trying to do their thing. But Anglo always at the end what the smart guys do in the beginning, and doing a large cap merger is precisely the definition of the end of phase one for me. Like, this is the sign that we're moving into phase two, and that's the cleaning out of whatever middle is left and dipping into advanced exploration plays where it's large, long life, high capex, 50-year, potential mine life. The grandkids will be mining this stuff. That's, I think, what is we're about to see over the next year is a wave of M&A. And the names, I'm not making recommendations, but I would be surprised if Taseko is still independent in 18 months. I would be surprised if Hudbay is still independent in 18 months. Like, I'm talking about these kind of, 1 to 8 billion market cap names that are already producing.
Capstone, Alea,
Capstone.
Samphire. I mean, Samphire's multiples insane, but yeah, there's
exactly.
And
it's just, get me the pounds. They're already producing. I'll pay what's optically a premium, but it's going to look really smart if copper, goes to 5.5, 6. You know what I'm saying? So I think that's what comes next now. And with that, I have a very high level of conviction that that's what we're looking at over the next kind of 18 months. So, call it, it'll be fits and starts, but then there'll be a headline deal, and you'll see like 2 or 3 all tip over within a year, and there'll be names that we all know.
To wrap on copper with a real specific one, Paulo, you have written and been thinking a lot about what's happened at Grasberg, Freeport's, half-odd owned Grasberg. How's your thinking evolved there?
So the moment that happened, I sat up, because it's not every day that a block cave creates an underwater flood and kills miners. And one of my favorite GIFs to use on Twitter is that that Biff Tannen Back to the Future 2 one, where he's the old man in 2020, whatever. And he says, there's something very familiar about all this. And the thing that was familiar for me was, I worked in LatAm markets for a while when Vale had the disaster at Mariana, and then the really bad one at Brumadinho, the two, mountains that collapsed, their tailings dams. And, Vale is still billions and billions of fines on the hook, and they'll be paying these fines forever. What was interesting then was, tailings dams didn't regularly fail, and suddenly you had 2 of them at scale fail in catastrophic fashion, including caught on video, where you're seeing, people driving those, huge, open pit sized mining trucks for their lives, like ahead of a mountain, just tumbling into a river. And it's terrible to watch. And you realize, like, okay, these guys are going to spend years just rehabilitating every tailing dam, going back to the science, like, how did this happen? And nobody really cared when the first one happened. Not a lot of people died with Mariana. It caused a lot of damage, but people got over it quickly. Brumadinho was like a real bad one. And with Grasberg, I can't say like I have every block cave collapse tallied on a piece of paper, but I don't remember when I heard the last one happening. And when it happened, the amount of silence in the immediate aftermath was very disconcerting, because it suggests to you that they don't even have a handle on the scope of the problem. And then a few weeks later, they dropped the presser before the open, where they, gave their official kind of first pass, and they were still looking for 7 disappeared and now presumed dead miners. I believe they found their bodies, and basically said, 2026, we're hoping to start ramping back up, and by 27, we'll be up and at 'em. Look, I'm not a block cave expert by any means. I'm a generalist that has, just a background in commodities, but I've seen what this thing looks like underground. Imagine, like, the movie Resident Evil, the video game Resident Evil, and the Hive underground, where like the tunnels go in every direction. Like, this thing is a city underground with thousands of workers running for miles. And this is a wet climate. A lot of us have read up on this. There are people who have commented on Twitter on this who are way smarter than I am. But that presser hit, and the copper price was flat. And it kind of makes you wonder, like, is anybody doing any work in commodities anymore? Or are we all just passive, NVIDIA rules the world, in this marketplace where there's nobody left with any level of brain or expertise? No one is paying attention. You have an 800,000 ton a year in a, call it 25 million ton a year market. So 3% of global production. It's not all offline, grant you. They're looking at 250,000 still to produce, but you've just knocked, call it 500,000 tons, 2% of global production off in one wallop. You couldn't say that about Brumadinho or Mariana with iron ore. These things were nowhere near as big of a percentage of global production as this is. This is also the largest gold mine in the world, by the way, in addition to being the second largest copper mine after Escondida. And they just told you that they're hoping to start ramping back up late in 26 to be back to full production in 27. But how do they know? A couple of weeks is nowhere near the amount of time to get in there. And then you also have significant risk around Indonesia, the fact that they had protests. There were several killings, deaths during the protests. The government has been shaky. Prabowo Subianto, the president, had to shuffle out his security minister, his finance minister, because in August, the Congress, the parliament decided to give themselves a raise, and people went crazy, and a taxi driver was run over by a police car and was killed. And so there were mass protests across the country. Nobody cared, obviously, like nobody watches this stuff. But this was a thing in August. It kind of quieted it down by October. But now you have this. And then you start to read between the lines, right? And for one, specifically to Grasberg, look, again, I don't speak for the company. I'm not short the stock. If anything, it's kind of like Cameco when Cigar Lake flooded in the 2000s. The stock's going to work anyway, even though it's their problem, because this is going to tighten the market and they'll make more money on the rest of their production than they do leaving money on the table through lack thereof. But there's a point of vulnerability here where, like, this is an emerging market, man. Like, Vale's lucky that some of these assets weren't nationalized in Brazil. They're just going to tax the hell out of them and fine them. But Indonesia has a history, especially recently, of keeping production in country. So they have prohibited Freeport from exporting concentrate in the past, encouraged them and forced them to build treatment and refining in country so that they're shipping finished metal. They started cracking down big time on illegal tin mining this year. In fact, they outright confiscated several smelters and tin elite, like 1,000 illegal tin mines, and threw those assets to PT Timah, the national company. Like, nationalization is a non-zero risk here. I'm not saying it's a base case for me, far from it, but like, it's a left tail affair, right? Where the country, like, just gets out of control, or something comes out about this. Like, what if, right, Freeport cut corners on gravity testing? Because this thing is soaked in water, right? It's in the tropics. You got to test the ore body for water. What if they missed something and the block cave collapsed and flooded everything and killed some locals, and the company's at fault? There's an independent investigation. The unions are asking to be involved in that. What if something untoward comes out and these guys are shown to be at fault and it wasn't just an accident? They're liable. What if that leads to, in the context of them going after the tin industry, they decide to just tax the hell out of this entity, or force a 30% ownership stake for the additional stake for the state at Freeport's expense to pay for the environmental cleanup and as a fine or what. I have no idea. I just know that this isn't a developed market. This is an unpredictable emerging market where things change, and I don't know, man. It's just, for me, it was invisible. Nobody cared. Even on the day of, after I read the presser, I'm like, how's copper flat? I immediately bought futures, started a rally, and we haven't looked back from there. We're kind of gradually tightening the market. And the sell side then goes on a conference call with management recently and just buys this hook, line, and sinker guidance from management that this is all going to come back online, that they've got their arms around the problem. I'm sorry. Like, I just don't believe it's going to be that easy. I would be skeptical, and nobody is, right? That leads me to other trades as well, some of which I haven't written about, so I'll kind of keep them to myself. But this is a potential problem that is now tightening the market in the way that even Cobre Panama and and it almost seems like one after another, right? Like this is kind of maybe the Cigar Lake equivalent, not in scale, obviously, but in sort of shock value eventually for this cycle in copper. You had Kamoa-Kakula had that earthquake; they were offline for months. The Cobre Panama issue last year. There are a lot of misses in significant assets in a market that's already kind of tight. I don't know, like.
Yeah.
It feels like to me like if ever there was a moment where we finally say goodbye to $4 copper, the stars are kind of aligned, and I just want to be there. And the way I express it mostly is in that junior producer and advanced exploration area, because the reaction function of the majors will be to add pounds quickly through M&A as that price deck finally re-racks.
By the time we air this, there might actually be another update out by Freeport. My intel, I've been asking around, just trying to introduce what reality looks like with Grasberg, and what I've heard is Freeport's likely to come out saying that they can ramp volumes from the non-block cave areas, but the actual, the block cave area itself, there's like between 7 and 9 kilometers of rehab that needs to be done. I think risk is certainly to the downside on your ability to ramp volumes from the block cave.
That's a really good point. They will pull levers wherever they can to try to manage the guidance, because the last thing they want is, Freeport's the only copper producer in the S&P 500. That suits them, right? In the same way in uranium, like Cameco is the only super liquid name, and no matter what the multiple is, if people are hot for uranium, that's where the pod shops and hedge funds and real money will go to buy first, because that's where the liquidity is. But it's kind of a not dissimilar case with what's happening with Cameco and McArthur River cutting their guidance. They've been slow walking this problem since the second quarter result, where they first whispered that mining is hard, McArthur River, clay in the new zones, this might take some time. And then a month later, in August, I guess it was, they dropped the bomb that it's not going to be 18 million pounds, it's 14 to 15. But just like you said, we're going to try to flex Cigar Lake, and we can do 1 million pounds from that. So there's no crisis here. And it's like, this isn't like when the uranium mill broke 2 years ago and you needed parts and some labor, and in a few months it was back up. Like this sounds like geology to me. Like this sounds like there's an issue here that may take longer to play. And what is the guidance for 26? Oh, that we always release that in February. Okay. But so, the Cigar Lake, like we can flex here thing, I get it a lot. Like it's, it makes sense to me that Freeport's going to do what they can around the different ore bodies there they don't want to be in force majeure for years, right? Like these guys are in the business of mining copper. I'm just saying that like this story is just getting started. There were rumors also recently within the last week that there are kind of press reports or articles on the come that the situation there is a lot more serious than Freeport so far as led on. But hey, it's just smoke for now. We'll see what they actually say and what happens. This is a point of vulnerability that the market can't just dismiss. And like geopolitics and fading Iran and Israel and all this other stuff in the oil market, we're so immune now to supply disruptions that the market didn't even react when they issued a press report saying this thing might be offline for a year, because Kamoa-Kakula had their issue, didn't seem to affect the market. Cobre Panama had their issue, didn't seem to affect the market. Geez, Tech guiding down at QB2, like that was a big one, didn't seem to tighten the market. But like, again, like nobody's paying attention. And I guess like what we're going to need is the forcing function, and suddenly somebody's going to miss a big shipment and go into the spot market, or like, take 200,000 tons out of LME and not be able to get it. And then people will realize, oh shit, the market's tight. And, here we go. It's often the smallest thing that it's a snowflake that sets off the avalanche. This was a big snowflake. I'm waiting for the little one that nobody sees coming, and then we know we got it.
It's such an enticing market, the copper market. And it does feel like we're kind of closer than ever. I'm keen to touch on a few other commodities as well, Paulo. Uranium being one of them that you've spoken a bunch about, and I know you've got a a long history with uranium, and you've thought about it pretty deeply. You wrote a piece 3 or 4 months ago. I think it was titled "Uranium in the '20s is what silver was in the 2000s," and that kind of sets the scene. But I actually want to ask quite a specific one about how your thinking around NextGen has changed to start, because when we did last speak, you were more on the bearish end that Arrow gets developed or gets developed in any kind of orderly time frame. But lately, you've written more to the point that you've been accumulating and building that position again. So how has your thinking changed in what is the most meaningful asset in the development space in uranium right now?
Yeah, that's a bit of a loaded question for me, because I view NextGen on paper. If I were a broker, I could pitch this all day. It's a liquid name in terms of investability from a liquidity perspective. I mentioned Cameco's like Freeport. That's where the big money will go to play first. But if big money needs a second name to rotate into that can torque and has a narrative to it, NextGen is it. NextGen reminds me a lot of Twiggy and Fortescue in the early 2000s. I met Twiggy before he had a mine. He was years removed from Anaconda Nickel, and he was pitching his project in New York, and the name of the presentation deck was the fourth force in iron ore. And I loved it because it was, iron ore was Vale, BHP, and Rio. They had just switched over from annual contract negotiations to a spot market, and Japan was, flipping to the Chinese in terms of the demand driver and who was driving the negotiations. And uranium kind of reminds me a little bit of that now, not in the sense that it'll go from term to spot. That's not going to happen, because as much as we would love that kind of level of price discovery and action, simply because of the lead time on the product for the natural commercial end buyer. The decisions to take a core loading start years before, the uranium that goes into the core loading is mined several years before the fuel is loaded. So because of that just lag in the cycle of production, you're always going to be predominantly a term market. But as opposed to iron ore, mine it, put it on a boat, put it in a blast furnace, ship steel, a couple of months, right? It's a short cycle product. In this case, though, like NextGen is sitting on a deposit that will wildly move the needle, and he is a little bit of Scorpion versus the Frog too, like Twiggy. He's like the disruptor in the space. Here's like stodgy Tim and Grant over at Cameco. Like, nobody wants to admit we overcontracted and got eager in 21 and 22, and we look stupid when uranium goes north of 100 because we're realizing prices at 60. But we've been conservative, bringing production back online, and our contracting strategy, yada yada yada. It's like, okay, at least you survived without going bankrupt. Like, I'll give you that over the last 10 years. But on the flip side, Lee is the kind of Twiggy, sharp elbows, sort of character. He's out there like, oh yeah, I'm sponsoring Formula One and the Canucks because like that's what the Saudis want to see, and like I want them to buy the pounds or like, anchor my next race. I don't know, whatever. He's living the life. But the more I've kind of honed in on this guy, and it is loaded for me as well, because I wrote this kind of comparison to Fortescue last April or so, and that was right when uranium was coming off the boil north of 100 on spot. And then he popped that convert and that raise where he, with cap, where he took a couple of million pounds and just, but like kudos to him, like he raised like right there at the top, and that was the end of the uranium cycle for a while, right? So his timing was impeccable. The more I kind of looked at the asset, the asset still has problems. It is nowhere as easy. It's like 25 million pounds is not a shoe-in. I get the pitch. This isn't ISR. It's not as complicated. A lot of this is still under a lake. Like, it's not going to be easy. But I'm starting to see hints that there's like some madness to the seeming throwing money about. I like the fact that he's been trying to keep a low profile recently because he wants the federal permits to go through without an issue. I question, for example, when he popped the $600 million raise he did 2 months ago, it was like, God damn it, Lee, again, like you just did this last May. You don't need the money now. Wait for $120 a pound with the stock at 12, then pop the raising, like make one raising higher than the last. You know what I mean? Like, do it the right way and stair step that thing up over the cycle.
It's upsized from 600. think it
Yeah.
came close to $1 billion Australian.
Yeah, over.
Oh, I was
Over
saying
just-
600 US.
Yeah.
Yeah.
Huge.
So it's 300 there and 300 in Canada, US. And anchors in both. I mean, it's kind of an open secret who anchored the Australia line.
Gina,
But let's
Gina
just say,
Reinhardt.
yeah.
Hancock Prospecting.
So supposedly of the 300, she put her hand up for
Two.
more than
150?
half.
150?
Yeah, I heard it was 200.
Yeah.
And another super, man, I got to check my notes. A major super also put their hand up for 100, and the book was basically spoken for, so they had to upsize to kind of fit people in. There was an anchor also on the US side who I don't know who it is. It's a very big, very real name. So what that suggests to me is that the Canadians who are all holders of this thing, all the top guys in Cameco, and there's crossover with NextGen holders, got barely a starter, and there's more buying to do in the coming weeks and months for them to actually get a position. But also, Cameco has done so well over the last 9 months. Imagine being a Toronto-based asset manager with $100 million position in Cameco that went to 300. Like, the case is pretty easy to then say, let me take 50 or 100 million out of Cameco and throw it to NextGen just to kind of spread the bet, especially since NextGen's the one with actual production growth. Meanwhile, like, Cameco, to their credit, despite the fact that they're kind of over contracted on the look back and having problems with McArthur River, and knock on wood, like I don't know this for any kind of, there's points of vulnerability at Cigar Lake, and I'll leave it at that. But production there has been fine. Their pivot, and I underplayed this at the time because I thought the acquisition was kind of silly, but the Westinghouse thing clearly paid dividends. And now what I think you're going to see very successfully is Cameco pivots from being a mining company to being a vertically integrated company that's actually an engineering construction firm and a developer of nukes that's Trump adjacent, yada, 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 through Westinghouse. When you run unit economics on what an AP1000 is, numbers 1.2 billion revenue, 250 million EBITDA per, put 10 of these together, you're talking, I don't know, 2.5, 3 billion of EBITDA, obviously stretched over time, and that's attributable to them. Man, you slap like a 15 EBITDA multiple, like a top end engineering multiple on something like that, suddenly you're at 35 billion dollars. Like, that's almost the market cap of Cameco. Like, so they can pivot their story away from low multiple, mining is hard, we missed again, or like we screwed up, to actually being a downstream company. And mind you, the more successful their E&C is, right, their AP1000 is, the more their mining company looks better, right? Because their production needs to feed those things. So they can also, have line of sight from this construction and this development track to filling that pipeline with, McArthur River expansion, Rabbit Lake coming out of care and maintenance, and other things that they need to track. Eventually, the deal that needs to happen here over time is going to be Cameco buying Arrow, right? Because Lee doesn't have a track record of actual mine development and production. It makes sense for this thing to be developed by Cameco or ANO, but Cameco and NextGen, like, there's no love lost there. The guys at Cameco, they can't even be on the same panel at a conference as Lee. It's old school versus, hot action. These two, I mean, they'll make an offer for NextGen if Lee stubs his toe and his stock is on his knees. But like, it won't happen otherwise. What's fascinating for me is I still think NextGen's asset has problems, but I see another strategy taking hold here also, because it started to drone on about this, but there's so much to think about. Lee is actually a pretty sharp guy. His conference call also this week was pretty interesting to listen to. I encourage people to have a listen, because it's clear that he's kind of 101ing what NextGen is and kind of simplifying it for people to understand. But there's so many interesting directions this thing can go. For example, he could decide to do the first 10 million pounds first, right, for a few years. Everybody's got 25 million pounds penciled in for 2031. But, he could make it okay, so he's got 5 million pounds or whatever of offtake, 6 million pounds, something like that. He can bring on 10 million pounds in the first few years and just squeeze the market. Or he can say, I'm going to do 15 million pounds to start, but I'm going to sequester 5. I've got access to Saudi money. You know, Sprott clearly doesn't do, you know, the best job, and Yellowcake in the UK is completely grossly incompetent and destroys value. Why they're not buying back stock with the premium down 10%, the discount at 10% today, after dilutively adding 50 million bucks to the last raise to pay for the Kazatomprom compounds, is beyond me. Sorry to be passionate, but like, I have multiple guys into YCA's management, like, use the excess money to go buy back stock and show that you can manage this discount, because Sprott can't do that. You can actually make a name for yourself as a real product in the space, so that guys aren't orphaned on an exit down 10% in a uranium price that's actually showing signs of starting to, like with fits and starts, to work. Anyway, back to NextGen. Like, Leah's talked about over the last 2 years about doing a sequester vehicle himself. You know, he lives in Adelaide, right? What if he were to do one in Australia? Now the locals down where you are and super funds could buy uranium Yellowcake a la Sput without having going to Canada or the UK. What if he seeds that and then spins that out, right? Like, I don't have any intel on this. I'm just speculating, but I've read some of his public statements and I hear how he talks. Kind of bottom line, I could see many ways where he uses this kind of, yeah, I said fourth force in iron ore, the third force in uranium, right? After CAP and Cameco, where he says, listen, if I don't get 125 or 150 bucks a pound for aero production, I'll sequester it. And, you know, he's got the dual listing for the stock in Australia as well, which always bugged me. Like, why are you raising in Australia? Like, who cares? Like, it trades by appointment anyway. It's not like institutional Aussie money's really trading there, right?
No,
But
matters.
it's kind of it's a planted flag, right? Like, it never made sense from a capital efficiency and allocation perspective. But, like, you know, he has talked about launching a sequester in the past, and nobody has one in Oz. So what if he were to do one and spin that out? And, like, you know, NextGen has a stake in the spun out sequester, right? And if he doesn't like the pricing and the term contracting he's getting from utilities, he just sells to the sequester and says, okay, like, you know, I'll wait, right? But he's doing it in a way that I didn't give him enough credit for his like ability to read how to piece this market together and squeeze it to motivate utilities to see the problem that brownfield's overcommitted, mining is hard. The guys who, you know, restarted contracted at the wrong price. Utilities don't want to pay up. What's worse is they didn't want to do anything last year because of the election. Now they haven't wanted to do anything this year, and that we're well below replacement rate contracting for 25 because they're waiting for Trump to do his thing. And if they screw up and there's not enough uranium, and or it's late and, you know, we have a problem, we'll just point the finger at evil speculators and plead with Trump for, you know, for salvation or something. You know, like, just go to the government and make it their problem. Utilities should be moving. There only seem to be one or two guys, in at least in the US, who have their own independent research that all point in the same direction, that we need higher pricing in uranium to incentivize greenfield, never mind future brownfield or bringing stuff out of care and maintenance. And as with everything, I think it just comes in waves, and we've chewed through the rat and mice production over the last 2 years of consolidation after we had that first big run in kind of 21 and then 23. And the third wave is now upon us. Volume and contracting will beget price discovery on the top side. It's not going to discover to the downside. The noise and spot where traders bank it down, like this move just recently in the last 2 weeks from 82 down to 77, almost no pounds traded. This is a highly opaque market that's just clamoring for price discovery. And unfortunately, unlike iron ore in the early 2000s, it's not going to get it with some transformation from term to spot. It's going to take, you know, adults in the room, or my kind of conspiracy theory, getting into the beauty that is Trump. You've probably heard me talk and write about, like, stay Trump adjacent. The guy is clearly pointing the fire hose at critical minerals. We all know this. I got this joke early in July, August, after he did the Mountain Pass deal. It was just like, who's next? Who's next? Who's next? And it's all started to come off the boil recently. Big crashes in a lot of names. Doesn't matter. There are points of contact here where Trump is clearly going to throw money. Chris Wright in Vienna 6 weeks ago, we are going to do a strategic uranium reserve. Amir Adnani from UEC teams up with Goldman Sachs. They initiate on his stock in August. He pops the follow-on, does his first real conference call after the result a month ago. The guy sounded on the conference call like the cat had just eaten the canary, talking about how things are imminent with the government. And then we got the federal shutdown. Commerce Department's been closed. They've been doing deals, but it's all been DOD, right? Like awards to critical minerals from Department of Defense because they're open for business. As soon as Lutnick is back in the chair and the DOC is open, we will see a plethora of deals. Guess what? The federal shutdown is set to end either tomorrow or Thursday, according to Polymarket. So I think we've got a lot of pent-up action in the Department of Commerce handing out and signing contracts. I think we're about to hear either the announcement of a strategic uranium reserve, which is basically the announcement of a third sequester on the playing field, only one who has unlimited ammo, or I should say, or a minimum floor price like they did with Mountain Pass and neodymium and some of the rare earths in the first deal, where they say, we want to incentivize U.S.-based uranium production. We used to do tens of millions of pounds a year 50 years ago. Now we do like a couple of million pounds. We are a 50 million pound a year market. We are wholly dependent on foreign supply. We need to 10x production now. There are a handful of players that can do this, and they tell us that they need, I don't know, $110, $120, $130 a pound. Let's call it $125 a pound. We will buy unlimited if you produce in the US at $125 a pound. I am high delta that either of those announcements are coming in the next few months. And it feels to me with the federal shutdown ending that it could be weeks rather than months. I don't want to say days because who the hell knows? I'm not in the business of trading zero DTE options, but weeks, months, definitely this stuff is in the crosshairs. And if it's a focus on U.S. production, will that help the Canadians? Can't hurt. I mean, Gina already owns NextGen. We know she anchored the raise. Gina got a membership to the Mar-a-Lago resort so that she can hang out there and try to get an audience with Trump. And she's down there like all the time from what I hear.
Yeah.
Right? And she's, very right-wing leaning. So she's simpatico to the message. And NextGen is the horse that she's chosen to back. And we know that she loves to have a seat at the table when it comes to talking M&A. You know, once Carney and Trump finally figure their end out and Trump stops beating up on the 51st state and decides to do the deal, I think he's waiting for Canada to do them last, right? Because they're the easiest to do with because, they're our neighbor. But we need everything they have, right? Like, what are we beating them up for? Like, we need heavy crudes. Are we really going to get it from Venezuela? I guess. Like, we're going to try now, we're going to knock out Maduro and get into jungle guerrilla warfare for 10 freaking years. I'm sure it'll all work out with the Orinoco, but Canada's easy. He's just waiting to do them last. So yeah, I see a special spot for NextGen in all of this. It's got room, and with $120 price tag, yeah, I know it's not cheap and it's a big asset. That's 5+ years away from production, but I mean UEC at $7.5 billion market cap. Jesus, that doesn't quite make sense to me, but that starts to make sense too with a triple-digit price tag and a floor price from the U.S. and maybe like a sprinkling of strategic uranium reserve. Like, why don't we have one? It doesn't make sense. Like, as with everything Trump, there's a kernel of truth wrapped in the giant cartoon of noise and what does he call it? Flooding the zone. But like the kernel of truth is like, we need a strategic uranium reserve. We need a floor price above the market to incentivize domestic production. Like, why aren't we doing this? So I'm here for it. And uranium, I'm size.
Yeah. Time to do homework on a lot of those American-based names was many months ago, and no time like the present to get underway. Oklo's another one I've got to ask you about though, Paulo. Like, it just crazy what has happened, and I think in the last month it's off 40 odd percent, but it's so interesting in the uranium world because it's a big part of a few of those ETFs that a lot of people kind of play in, which is something that just makes me think about what correlation turns to when people run away from these things. But yeah, there's a lot of kind of moving parts to it, isn't there?
I'm sore with Oklo for one because I wasn't involved, and hey, if it's going to go up 10x, like I want to be there. I don't care if it's a Ponzi.
Don't we all?
But yeah, it's also hard because it is in the URA, which is the largest ETF. You know that Oklo is, you're going to crap when you hear this. Oklo is the largest weight in the Russell 2000 value index. Value.
Who makes these things?
It's also, it's a top, it's a key weight, top 10, I think, in the Russell 2000, full stop, top 20. I have to double check there. But in the Russell 2000 value, it's the largest constituent. Like, riddle me that. It's like when you talk about broadening out and getting into small cap, like, you just can't take this stuff seriously anymore.
It was half the size of Cameco for a while there.
And this isn't going to be a product for years, if at all. But I guess we're going to throw billions at it, and we're going to make it work. Where there's a will, there's a way, especially when you throw billions at it. But the problem is that, like, this pollutes. This space needs money, but it needs money like where it matters, right? Enrichment, conversion, and especially U3O8, that matters. Pie in the sky technology that maybe works. And listen, I don't want to speak bad and like really crap all over it, because there are hitters there, and the management team, like, they're no dummies. Like, this stuff could work. It's just like, it feels like we're skipping a step. An AP1000 works just fine, and the Chinese equivalent, they build these things for $2 billion. Like, our Vodal in Georgia cost 15 plus billion because we spent 15, 20 years building it, and every 2 years they had to go back for new permits and redesign stuff, and the cement is wrong, we need to do that again. Like, if you cookie cutter this and you say, and this is kind of why I like the Brookfield deal as well, the first few are going to be really expensive. But once the supply chain and the labor is retrained and set up, like, the first 5 to 10 are hard. The economy, it's not even economies of scale. It's the experience of doing more than a few of these. Georgia can't do 2 and then, it all works out, but then you stop. Like, this needs a Marshall Plan where the first few are going to be carried by the government as a public loss, because it's going to take a few of these to do economically. Then why, like, just expect that the latest tech is going to be the answer? It'd be even crazy if we were like, oh, we're going to make molten salt thorium work, and we're going to do it in 3 years. Okay, I guess, but like, isn't it just so much easier to take 50-year technology that's been wildly improved on the margin from a perspective of safety and efficiency, and just learn how to do that all over again while you work on that other stuff for the next 10 years? Like, it almost feels like it's kind of like what like in Africa, where guys said, let's skip the step of building fixed line telephones because cell phones are so much easier and more efficient. Like, that I get, but like, SMRs aren't even a thing yet. Like, let's focus on SMRs if they exist and they're cheaper and more efficient and have a proven case. But the problem is, like, it memed. It's now the largest constituent in the Russell 2000 value index. It is a top holding in URA, the largest uranium index. So it's like the fire hose of passive as well as government money got pointed in a direction where the payback is going to be a lot harder and take longer. I'm like willing to be surprised, but like, the payback is so much more immediate on the stuff that's proven. But I guess, like, it's kind of spaghetti against the wall. Like, they're throwing it at everything. The Brookfield deal, that made sense. That sounds smart. A strategic uranium reserve and subsidizing or guaranteed pricing on U.S. production, like, that makes sense to me. I don't love the fact that government's getting involved in, the economy like this, but, there are no atheists in foxholes. Where else are we going to get this stuff from? So, sorry to drone on about it, but the Oklo case has polluted. They have Oklo single name 2x ETFs now. So, like, they have levered ETFs just on Oklo. They, like NVIDIA, they have, heavy weights in all these ETFs. the fire hose is pointed in the wrong direction. Like, that's a point of frustration for me, compounded by the fact that, like, I should have known better. It's tech, it's AI adjacent. A lot of the guys own it who are in that AI world. So it's going to meme, and retail's going to love it. And then the leverage is going to pour in, and the ETFs are going to buy it blindly and take it up waiting wise, blah, 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 blah. Coulda, woulda, shoulda. But it's frustrating because it doesn't address the more acute issue at hand over the next 5 years, which is we need to invest in supply chain. We need enrichment. We certainly could use some more conversion, and we need more yellow cake.
Yeah, absolutely. And I think those, the double and the triple levered products that you mentioned there are, I'm curious to see how they're viewed upon 10 years, 20 years down the road. There's one more commodity I've got to ask you about, Paulo. There's, the copper narrative, uranium, what you've spoken to, they're all pretty tantalizing, but you made the comment a little while ago that oil is to 2026 what gold has been to 2025. I'm keen to hear as much or as little as you want to talk about this one, because I find it a super enticing space to play in.
Yeah. I remember I went on a long diatribe about oil a year ago with you guys, talking about like long oil sands, short Permian. And
That's
then,
right.
of course, Trump beat the shit out of Canada, and, kind of, oil sands have been coming off the mat, I guess. But I like the fact that oil has been so relentlessly kind of beat up every time it prairie dogs and pokes its head up out of the ground that it's not quite left for dead. It's just, it can't possibly work because Trump doesn't want it to work. So if it rallies, he's just going to beat the hell out of it. And, he wants lower oil prices by hook or crook. Okay. I guess like the future of the world is totally in his hands. But there is a quote spring issue going on in oil that I'll try to distill down in as few minutes as possible. And basically, it's that with the Saudi or the OPEC cuts being unwound, a buddy of mine over at HFR Research, who's a real barrel counter driven by the data, he always called it the Saudi cut. As the Saudis unwound it, the first kind of couple of 100,000 barrels earlier this year were easy because they were doing it in advance of the cooling season in the summer where it's 100 plus degrees. They have oil fired electricity for AC, what have you. And the rubber was always going to meet the road after the summer passes. And we are seeing builds, generally speaking. How much of that has to do with demand not keeping up in the West versus Ukraine just bombing the hell out of Russian refinery capacity and products not getting to where they need to go? You're seeing crack spreads moon, right? Like, we're at 30. Refining stocks are on a tear. The refining is actually, if you look at products, right, diesel, gasoline, like crack spreads right now, just the spread looks like it's doing what it did in the lead up to the invasion in 22. Like, those guys are reliving the same cycle where they're just mooning and it's never been more profitable, but oil can't get off the mat. And we're in a window here where the equities have already started to sniff out a recovery. And guys were selling oilfield services stocks like Weatherford that had gone to 135 a year ago, in the 30s, just 6 months ago. We're back at 72, 75. Schlumberger, same thing. Like, we've seen even the offshore guys, like Valaris was, I think, 20 handle. Now it's in the 50s. A lot of this stuff has already bounced. Tidewater went to north of 100. So I don't know, 30s, now in the 50s. Equities always kind of smell it first because there's the optionality of a turn that's kind of being sniffed out. But what I think is interesting here is we are in kind of the last bringing on the available surplus capacity as exhibited by OPEC. Like, we're down to, I personally have believed and continue to believe that the Saudis don't have the wherewithal to take production above 10.5 million barrels a day. This is evidenced by the fact that they did it during COVID. And the moment they got above that number, 10 and a quarter, 10 and a half, they started to draw above ground inventory. They're capable of doing more, but they have to invest for it. Funny enough, they've started to send up flares about bringing shallow jackups back on. they're starting to tiptoe towards some CapEx in laying the groundwork for what I think they see 2 to 3 years out, which is we don't have a lot of runway left. They've got, I think they're kind of mid nines now. So they have less than, call it 1 million barrels of capacity to go. UAE has a bit of spare. Iraq is almost there. Key players are pretty much there. Non-OPEC, Brazil, Guyana. There's not actually a surprising amount of room there. That's where the growth has been. There's not a ton of room there. I kind of shake out into like the maybe 2 to 2.5 million barrels left, not even. And that's not a lot of room in a market doing 104, 105 million barrels a day. And according to others, like we're doing more than that. We just don't see it. And the biggest tell to me is China is the best physical oil trader in the world because they have to be, right? They've been building out new tanks and they've been filling them with oil in the 60s. If they thought that we were going to see 40 or 50, they wouldn't be buying. And they've been waving it in. I don't know. For me, I'm finally kind of seeing us get to a point where, especially with a weak dollar, debasement, Trump, what have you, the dollar rolls over again. You're going to have one hell of a demand push in emerging markets, which is where that S curve of $3,000, $3,500 per capita GDP, GDP per capita kicks in. And the kick definitely shows in OPEC commodities like energy, because the guy goes from taking a bicycle to buying a scooter, right? Like that whole kind of step function where the intensity of energy consumption steps higher. So to put a bow on it, the equities are clearly sniffing a turn. We're transitioning to a world where for decades, OPEC always had millions of barrels of spare. Market would rally, they bring on production, market would fall. We're kind of getting to a world where there's got to be a lot of expenditure to bring on supply growth at a time where demand could go from that kind of steady eddy million barrels of growth per year to a pop as you run into this S curve in the global south in the next 2 years, precipitated or helped along by a weak dollar, that, like the U.S. doesn't really grow on the products front. Like we're GDP per capita here, like we're past the S curve. The developed market is already consuming its, 10, 12, 13, 20 barrels per capita annually. China's doing 4. I think Korea does 13, US, Australia is at 20. I have to refresh my notes, and again, I'm a bottle of wine in, but there, India's at 1.5. A billion people. Like, let's do maths. If India goes from 1.5 to 2 barrels of per capita consumption annually, just a half a barrel per capita, that's 700 million barrels in a year of growth. Dude, divide by 365. That's 2 million barrels of incremental on 105 million barrels a day. So you go from 105 to 107. Maybe that happens over 2 or 3 years, but like India's growing, man. So there's not an awful lot of spare to, basically what I'm saying is we've got Hacienda hedge in Mexico to do here, between Thanksgiving and Christmas. We've got builds, which nobody likes to see because we should, refineries have come out of turnaround, right? We should be seeing, I guess we're going to be building into the winter months. That's fine. But we better build a lot, because if EM comes out in 26 with some punch and the Saudis unwind the rest of their cuts like mid next year or later next year, oil's going to run into a situation where, incremental 20,000 barrels, 50,000 barrels from private players is not going to move the needle. And the key players are not going to have the spare. Plus, like, Russia's, I tend to think that people overdid it on the whole fear of the CapEx is all going to flee and their production is going to immediately tank. It didn't. But they're now 3 years into this. 5 years of underinvestment in these fields, like, you start to see it. So the equities are smelling a turn. The way I'm playing it personally, I'm in December 27, so I've got like 2 years left on this stuff. $100 calls on WTI futures, for $1. Dude, like, can oil, and the curve is flat basically, right? Like in the 60s. Can oil rally 50% to 100% in 2 years? Of course. Like in a situation where we start to bump up against global capacity, yeah, I'm not saying it'll moon, like, because you get demand destruction above like 125, 150. But dude, for $1, like, yeah, I'll take. Let's skate to where the puck is going to be. The curve starts to backwardate, gets tighter and tighter as we work through 26 into 27. World's growing. They're running it hot. Everybody's running it hot. Everybody's in the fiscal. EMs are on fire. And now oil's 130. Well, that's 30 to 1, man, to be in the money. And like, would that be so crazy? Like, we were just at 125 3 years ago. It seems like longer dated options are mispriced. But the way to do it for you, for most people, is some of these equities, like, you can 2 or 3 bag, right? Like for me, I like to tuck stuff in the back of the book that won't bleed on me because I've got so much time. But the equities right now, like, have already smelled the turn and are telling you that we either like need a real serious globally synchronized recession to, kind of preserve that buffer in supply, or, the price deck is going to have to move as well. And I guess, like, for me, gold worked this year. The miners, like, felt like they should have worked a long time ago. They've re-rated with the gold price, but they're still kind of trading similar multiples. Like, they're gushing cash. Free cash flow yields are high at 4,000 an ounce. Like, nothing's really changed except that they just kind of tracked and somewhat outperformed the gold price, but they had margin expansion because of cheap oil. But gold was invisible a year ago, despite the fact that the price was already running, with post-Israel, Hamas, and all that stuff. Like, we were already knocking on 2,800 a year ago. Then suddenly the gold miners woke up in 25. I don't know what made people wake up. Like, I guess people just saw that they were cheap. Oil equities are cheap. Like, they're invisible. Like, oil is invisible. Like, it's not even contentious anymore. Just nobody gives a crap because it never works. It's been in a slow bleed forever. At some point it'll start to work, and then the equities will look really cheap. And suddenly, like, I don't know. That's why I say, like, for me, the meme is oil is to 26 what gold was to 25. Oil E&P and oil in 26 is what gold was in 25. Changed my mind. Like that silly guy, like, sitting on the campus with his little sign. So I think that's not to impugn gold, but, like, doesn't it also fit? Like, the gold oil ratio is really something right now, right? Kind of
like 60 or 65 or.
Yeah, like, are we really going to live in a world where it's 100?
Yeah.
Like, do we really get that good at drilling for oil? Like, bravo to the industry. I get it. Longer laterals, bro. But, like, and that's the other thing also. There is this debate, it shouldn't even be a debate, that a lot of the Permian production, which is plateaued, we had a pop. Guys are clearly harvesting a lot on the Iran hedges since June, but now we're coming back down. And we went from suddenly spiking above 14 million barrels a day in IEA data for August and September to, like, now back to like mid 13s on the weekly. And what's interesting about all this is, like, this was very clear in June on the Iran pop when they bombed Iran, that commercials were hedging like crazy. It's natural for them to do this, but those hedges are now, like, they're playing through. And it's something that we see in natural gas drilling as well. Like, it's a free option to hedge for these guys in the Permian because, and equivalently in the Haynesville for nat gas, think, like, let's say you do 100,000 barrels a day. You get a pop in the price. You go out and you hedge 100,000 barrels 6 months out. If the oil price has rallied, you go out, because this is short cycle stuff, you spud, you frac pad a ton of stuff real fast, and you now do 200,000 barrels a day, and you deliver 100,000 into the hedge, and you sell your original 100,000 at the higher spot, and your income statement looks amazing. If the price collapses and you hedged properly, you just deliver into the hedge, but you don't grow your production from 1 to 200,000. So hedging actually introduces optionality for the commercial to flex. And that's clearly what happened after Iran in June. But, like, suddenly the numbers are reversing pretty fast. So it shows you that the hedges are running off and guys are not reinvesting in the patch. On top of that, there's a lot of baking soda in the nose candy, guys. Like the natural gas liquids that keep getting talked about. The EIA is totally silent on this stuff. They've been asked point blank, are you misclassifying NGLs as crude? Like, I don't understand why they just won't come out and clear this up. But when I talk to guys who operate pipelines, they're seeing this content. They're seeing paraffin in a lot of the grades that they ship as well. You got to heat those pipelines to keep the oil moving. There are games being played to quote unquote maximize volumes around the edges because tier 1 has been largely drilled out. It's not just longer laterals and more efficiency. That was a lot of it. But now they're cutting the crack cocaine with crap to keep the product volume up. And that's a game that you can only play temporarily before refiners push back and you see the NGLs come out of the process on the other side and they're not usable. So I see enough here to suggest that the Permian is tapped out and we're going to need a higher price deck to make tier 2 acreage, gush the way tier 1 acreage has gushed for the last, 8 years. But like in the context of the global supply picture, we talked about OPEC and how much spare they might have and the Permian and how much they can flex. I just don't see us going into the 40s. And if demand gets a kick, there's not a lot of low-hanging fruit to bring on to restrain a trend in a market that's been getting beat up for 3 years running now. So
yeah, I'm with you there, Paulo. It's such a hated space, and that's why it's hated, or in your words, invisible, and that's why
it's invisible.
Yeah,
I prefer invisible to hated because hated is contentious. Invisible, like just nobody cares.
Nobody cares. Yeah,
nobody cares.
I
It's like nobody
more.
cared about gold a year ago, and Iran and Israel were already kind of kicking the shit out of each other, and nobody cared. And you're sitting there and you're like, how's gold not mooning? And then we woke up to 2025 and here we are at 4,000. Like suddenly it works. I can't explain it.
I'm totally with you there. Paulo, it's been great to chat again, to hear your thoughts and get up to date with everything you're thinking. I'd highly encourage everyone listening to check out your Substack. We'll include it in the show notes so people can find it nice and easy. And yeah, thanks once more for making time so late at night over your ways on the east coast of America there.
Yeah, I'm sorry to drone on. I'm already guilty of talking too much, but you catch me at 9:30 at night, a bottle of wine deep, and an hour turns into an hour and a half. And I apologize to your listeners for that, but that's just me.
That's why we like having you on the show, Paulo. Much appreciated, mate.
Thank you so much, Paulo.
My pleasure. Good being with you guys again. We'll talk.
Always great to get Paulo back on the show, mate. Flesh out in sort of long form some pretty big ideas, some things that you need to kind of think through in our space.
The big stuff informs the little stuff, mate. And speaking of big stuff, we've got some big partners that we could not do this without.
Sure do, mate. Sandvik Ground Support, the legends, check them out. Details in the show notes. Focus, the platform by Market Tech. Check out the wicked platform that they have put together, a local Aussie team doing God's work.
Mate, it is a great place to trade, to dissect, to analyse. It is, it's a institutional platform at a retail price. Thank you, Focus.
It sure is, and there's a free trial in the show notes as well. And last but not least, Intralinks. Check out those legends as well.
Hoodaroo, mate.
Hoodaroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read our disclaimer.